Hello everybody, welcome at a new video at the start of the week and also at the start of the month as it is the 3rd of February. My name is Julius de Kempenaer and I'm recording this on Monday evening just after the close of the US markets. For this video I want to take a look at seasonality because it's the start of the new month. But before we do that, I want to take a quick look at the charts of the S&P 500, SPY, and the current situation in sector rotation. Starting with the weekly chart of SPY, we can see that the longer term rhythm of higher highs and higher lows is still in play. But what we can also see is that the distance between the highs and the distance between the lows is getting a little bit less. If you look at the moves here, you can see that these highs are significantly higher than their previous highs. And also the lows are significantly higher than the previous lows. Well, that situation has now changed. If you look at the most recent high, which was 2 weeks ago, you can see that it is only barely higher than the previous high, which was set in November of 2024. And also the most recent low, which is 575 or 582 3-4 weeks ago, is only marginally higher than the previous low here. So it looks as if we have a market that is going into some form of a consolidation, and that's not strange after such a strong move. Now, in consolidations, two things can happen, or corrections, two things can happen. You can have a correction which is actually a correction in price, just like we had here, where the price actually goes down for a prolonged period of time. But you could also have a market that moves more sideways. It starts to digest that rally, to digest that supply in a more sideways fashion, which is actually pretty strong because it means that there is also a good amount of demand that is catching that supply. And that's causing a trading range. It looks as if we're getting a situation like that here now. So the lower boundary, probably around 580, 575 if you take the extreme here, and then 610 on the upside. So that's the trading range that I'm watching for SPY right now. Very clearly, when we take out that 610 on the upside, 611 on the upside, that's a trigger for a further continuation of the rally. On the other hand, a break of the lower boundary here would trigger signal that a little bit more of a corrective move is most likely needed. And because we are in such a long-term uptrend, there's plenty of support underneath, so that it's very unlikely that we're going to see a crash or the bottom falling out of the market. Again, that 575, 580 range, that's definitely a good support level. And then if that breaks, we're watching 565, which is also still very, very decent and very nearby. And if push comes to shove, then maybe even we could see a decline towards this old rising resistance line, which is now expected to start acting as support. If we take this to the daily chart, that's a little bit more granular, then you see what I mean with that trading range. You can see how since December of last year, the market has now started in a trading range. 1, 2, 3, 4. This could be even seen as 3 weeks where the market is pushing against that 610 level and it doesn't break. We drop down, we tried it again, and now we drop down again. So we're in the middle of that range. And then here you have that sort of an area range between 580 and 585 where the market was caught a few times. And then here's that 565 level that also was visible on that weekly chart. So on the downside, I would say plenty of protection until 565 and then even that old resistance line acting as support. And on the upside, there is decent resistance around 610. That is probably going to take a couple of weeks to play out before we actually get a very clear sense of what will happen in the weeks after. Looking at the current state of sector rotation on the RRG. This is the weekly RRG for the sectors. And if you follow my weekly blog on the best 5 sectors, which I've started at the beginning of the year, the best 5 sectors right now, according to the setup I use in that blog, are consumer discretionary, communication services, financials, technology, and industrials. And it's very clear that all four are actually clearly the best. And then industrials, which is on a negative heading and a negative tail, is still the best of the rest. It wouldn't be my first choice to pick, but I've forced myself to take the best 5 sectors. I've done a lot of backtesting there, and the results on this approach, where I combine a weekly and a daily RRG metric, actually give very consistent outperformance over the S&P 500. So the industrial sector needs to be in there. Discretionary, communication services, financials, tech, and industrials. And tech just arrived back into that top 5 sector after it was disbanded a couple of weeks ago in favor of energy. But the energy sector actually turned around and has now dropped out again. Let me highlight those sectors for you so they're better visible. Discretionary, communication services, financials, and then we have industrials and technology. So here you very clearly see the best 5 sectors for the time being. If we bring this to a daily chart, and I highlight the same 5 sectors, so it's financials, communications, industrials, tech, and discretionary, then you can see how they're all doing pretty well. And you can see how industrials, which was on that negative heading on the weekly, actually, this is the reason why industrials is inside that top 5, because it's a very strong daily reading. So we're combining the dailies and the weeklies. That's why industrials managed to sneak in there. And you can also see how technology, despite the fact that it is in the lower left hand, the lagging quadrant on that daily RRG, is in there because of the continued strength on that weekly RRG. So the setup for the coming week, and hopefully a little bit longer, is for those 5 sectors to outperform the S&P 500, or a portfolio of these 5 sectors to outperform the S&P 500 going forward. The individual charts for those 5 sectors you can find in the article. They're printed at the close of last Friday, so not a lot has changed as of today. Here is the images, and here is consumer discretionary, nice breakout, good relative strength. Financials trying to break higher, good relative strength. Communication services, probably the strongest of all, very nice relative strength. And then here you see why industrials is on that negative heading, going into the lagging quadrant on the weekly RRG. And you can see why technology is starting to creep back up, even despite the fact that the relative strength line is more or less sideways. If you track those blog articles, you will find the best 5 sectors every week, including the performance as I measure it going forward. And then for seasonality, those of you who watch the show more often, or regulars, know that at the start of the new month, at the end of the last month, I try to look forward using seasonality and try to combine that with RRGs and see if we can find alignment in the theoretical sector, the theoretical situation based on seasonality, and the current sector rotation. And I used to do that with the traditional seasonal tools, like the one that you see right now here on Stockcharts, where we plot seasonality. We go back 20 years and we look at the performance every month, the percentage of months in which SPY closed higher than it opened. And when we do that for individual sectors, for example, let's say materials, and then compare it to the S&P 500, then we would look at the relative performance for that sector versus the S&P 500 and see which months the sector is expected to outperform and by how much. And it's something that I had wanted to do for a long time, but it's a ton of work. But I finally managed to squeeze some time in. And what I did is I actually took all the data going back to pretty much for when it was available for the sector ETFs, which is around 2000, somewhere a little later, as well as for SPY, and broke it down into trading days. So every year has a number of trading days. It varies. It's around 250 trading days. And I took all those trading days, took all the data points, all the closing prices from those trading days, and took the average day-to-day change and created a seasonal pattern based on that day-to-day change. And I put that into what we have on Stockcharts as a UDI, which is a user-defined index. And that gives me, for example, this result here. So let me talk you through what we've got here. So the dimmed candlestick chart, the ticker symbol is at SPY Seasonality. That is the one that I calculated, and it's printed in the background. And because it's seasonality, we can look forward. So you can see that it now has data for the entire year of 2025 based on the seasonal expectations. The bar chart on top of it is the actual performance, of SPY since the start of 2024. I needed to give it a little bit of a lead in to build up. And so we've got that year, and now we can start 2025. And you can see how on large the market is kind of following that seasonal pattern. But what you also see is that it is a lot more granular than what we had on that monthly spreadsheet or those monthly bars where you can only get a blob for 1 month. And obviously seasonality doesn't really follow a month. It's a much more granular process. And that's what we can see here with these based on daily charts. I can actually switch this to daily, and you will see the daily pattern for that same period. I like to do it on a weekly because it's a little bit more, it's easier, it's more smoothed out, and it gives you the bigger picture. I don't believe in seasonality on a day-to-day basis, but as a data set, it's nice to have. So we started the year and a little bit of a dip and then a rally, and that's going on until the 10th of February. And then normally in seasonal patterns, we get a couple of weeks of a setback, and then the market starts to rally again somewhere mid-March. That is the usual part. And that's interesting because you can see here that the bottom is in the first 2 weeks of March. If we would go to the standard SPY seasonality chart, that would not be visible. So we said the first 2 weeks of March, but here is just the whole month of March is a very strong period. And you can see that it's actually only starting on the 2nd, because in the first 2 weeks, it's actually not too strong. So this approach gives me a lot more granularity in terms of analyzing the seasonal patterns. So for the S&P 500, it looks as if we had the little rally. We're now in some sort of a consolidation setback, which will last, okay, we can count here, 1, 2, 3, 4 to 5 weeks. Second half of March, that's where we start to see a bottom in the seasonal and probably a further rally. Let's see if this pans out, if this year is actually going to follow the seasonal pattern very well. As I said, we would do that for relatives as well. And I've done that. I've got my chart list here. For example, if I can do that for materials, you will see the same picture for the materials sector. So the dimmed candles is the seasonal pattern for the materials sector, and the bars are the actual performance for the materials sector in real life. You see, it's a lot more volatile and it's a lot wilder. So to get to the relative, I created because I have all these UDIs, because I've got the UDI for every sector and the UDI for SPY. So I've got the seasonality for every sector in a UDI, and I've got the seasonality for SPY in a UDI. And when you look here, this is the relative strength. Let me load it up. So at XLBCs divided by at SPY-Cs, that's the seasonal pattern for the relative strength for materials seasonality. And you can see that it is oscillating around the 0%. This is the real life performance. You can see that it is it's much bigger swings, but you can see that the it's following the pattern. So we got this dip in the beginning, then we got a rally, and we top out somewhere here. This is 15th of April. Then you got the decline, a little sideways move. Here it was a big of rally, and then you got, so here it went off the rails. So materials at the end of last year totally did not follow its seasonal expectation. And now we are here at the start of the new year, and according to seasonalities, we should see pretty strong performance for the materials sector until somewhere beginning of May, month of May. And I've got this for all the sectors. So let's just, because I have the data, let's do it for all the sectors. So here materials looks as if it's going to go in a right way. I'm only going to do it for the relative performance, not necessarily for the absolute performance. So here is communication services. And you can see that that is it's a strong sector. This is data going back more than 20 years. So overall, communication services has been a really strong sector, and you can see that the expectations here are actually very good on a seasonal basis for communication services all the way up until the summer, somewhere mid-July, and then we go into some sort of a sideways move. So we basically have just started the best part of the year. Communication services, also one of the top 5 sectors, as you know. And then we go to energy. And here you see energy. It's a shallow decline, and that's because the seasonal pattern is an average. And to me, this means that we have seen a bit of an up move. It was an early peak, and then you see it's coming down. It's coming down much faster, but it's following the seasonal pattern of the energy sector of actually underperforming the S&P 500. This year, 2024, it did that by a much bigger margin than we would expect based on seasonality. Here also, the start of the year is the better part of the year for the energy sector. So energy could be one of the better sectors going forward. If you look at the sector rotation current, maybe not, but from a seasonal perspective, it is the better part of the year for the energy sector. Here is financials. And here also you see how financials is actually a very stable sector. You see that the swings on a seasonal on the seasonality basis are not that big, and it's damped because of the 20 years of data. And here you can see that again we're following the pattern of the seasonality, but the swings are much higher. You see that the dip here came exactly around the summer. And then it started to rise, and we see a rising pattern from basically from the summer all the way until the end of the year. And that's exactly what we're seeing here. For financials, we're now entering the weaker part of the year. So it looks as if financials have had their go. They're still in the top 5 sectors. We're going to let the algorithm do its job, and if it wants to kick financials out, then you will read that in one of the upcoming blog articles. If it happens, I don't know. But according to seasonality, the weaker part of the year for the financial sector is starting, and it will end somewhere in June, July. And if we then go to industrials, again, you can see how the reality is showing us much wider swings than the seasonal pattern. But here also a rally, a dip, and then a rally. And then I think that this peak here is this peak. So you can see that, you know, the reality doesn't always line up 100% with the seasonals, but sometimes it comes early, sometimes it comes late. And I think that this peak here, we can safely say that this was the end of the year peak. We saw the decline, and maybe we've been early here, or we need to go all the way down somewhere into July. But we can safely say that in the industrial sector, the seasonality is not going to help us very much. Again, also a top 5 sector, so we have to see what happens with the algorithm. Here is technology. Again, this is overall, over the last 20 years, technology has been overall being a very, very good sector. Last year, we had this big diversion from that seasonal pattern. And right now, quite frankly, if I look at this, it's pretty much sideways until somewhere in May, and then we get a good period. So let's take a look at how this unfolds, but from a seasonal perspective, the technology sector will still be under pressure. And if you look back to the price chart of XLK, we've seen that it is pushing against overhead resistance, so it has trouble. It also has trouble in terms of relative strength, and it would sort of coincide with what we see right here. And then we've got staples. Staples, very defensive sector and not big moves based on seasonality, but you can see how this huge underperformance happened at the end of last year. It is following the seasonal pattern. It's showing us an underperformance, but the margin with what is happening is much bigger in reality than expected based on the expected seasonality. So right now we're entering some sort of a sideways range for the seasonality, for the consumer staples seasonality. And now we go to real estate. Real estate, this is a very long period of history, been doing really well, real estate. And here you can see how the reality basically went totally off the rails. So real estate in 2024 did not follow its seasonal path whatsoever. And 2025 is going to be a surprise. If I align it here, it looks as if we have bottomed. So that would suggest that we're starting a good period for the real estate sector. But we do need to see it happening in reality, because this is all theory and this is reality. This is a bit of a guideline, but you can't trade on this. You just have to get confirmation in the current sector rotation or the current price pattern on the charts. Here is seasonality for utilities. Again, a very defensive sector, no big swings. And then in reality, you got these huge swings going from -9 underperformance to +7.5 outperformance. Here you also see that it is, at least at the last few months, it's tracking the relative performance because that started to move down. We could expect a little bit more downside, and then we start to move sideways again. And that's actually the better part, because utility sector, very defensive in general with the bull market that we've seen over the last 20+ years. This is a sector which has underperformed the majority of the times. So even when this goes sideways, that could mean that it is a good month or a good period for the utility sector. Now we go to healthcare, same story. Defensive sector, very shallow. Overall, outperforming the S&P 500, but not by enough to make it a really strong sector. And here you can see those huge swings. Here also, this is a decline based on seasonality, and it's following that path, but with a magnitude that is much bigger. And then here, I think that this is the rally that we've seen, and we probably are now on the way to peaking and then going into a weak period again for the healthcare sector at the start of this year. And then the last one is consumer discretionary, one of the growth sectors, just like communication services and technology, where you see that seasonal line steadily moving higher. Here we see how consumer discretionary went absolutely off the rails in 2024. It only caught up in the second half, and we have to wait and see how this unfolds. But we have had a peak and a bottom, and it is going into the right period of the year for the consumer discretionary sector. So according to this seasonal pattern, it is rightfully inside the top 5 of the best sectors, because it is a sector that's, from a seasonal perspective, is actually going into its best months of the year. If we bring that information to the current relative rotation graph, then we can see that consumer discretionary is actually in a strong period. So it's rolling over right now, but it's got a high reading. Communication services are doing really well. Technology was kind of okay, and we saw financials and industrials were the two seasonal patterns that were kind of starting to underperform. So they're in line with their current tails. Despite that fact, they're still in the top 5 because they are furthest to the right. Anyway, I hope I have created something that is a little bit out of the box and new. These are UDIs, user-defined indexes, so I can't share them with you in a chart list. I will try it. I will see if I can. We're going to try either one of those things. I'm either going to create a zip file with the raw data, which you then would have to import into your own Stockcharts account, or I'm going to see if I can get those as formal ticker symbols into the Stockcharts database, where every user could, I'm not sure what the ticker symbol would be, but for example, hit XLBCs, maybe dollar $XLBCs or exclamation mark, whatever symbol we come up with, so that it is an official Stockcharts ticker symbol that we can use going forward. And then we have to update that, let's say once a year with the next year looking forward, so we can have some sort of a roadmap based on seasonality. Let me know what you think of this approach, whether you like it or not, whether I should push to actually get this on the Stockcharts database, or any other comments that you would share with us. Thank you for watching. I hope you enjoyed it, and I'm looking forward to seeing you again next week, same time, same place.